And we're joined this morning by the former president of the Federal Reserve Bank of Richmond, Al Broaddus, joins us now. And Al, good evening to you. Thank you for sharing your time. Let's talk about what Bernanke had to say testifying today in Washington. What do you think about this new measure? I mean, it looks like, they're trying to exit their stimulus. Is this an effective strategy?
Well, I think so. You know, this just to repeat what the chairman said, he made it clear that they're not ready to move yet. And in that statement that he made that you broadcast just a minute ago, he said it's going to depend, and that's true. It's going to depend on how quickly this recovery begins to develop momentum. It will depend in particular on any signs that inflation or inflation expectations are moving towards an increase in inflation, and the latest data don't show that. So this was all about contingency planning. It was about signaling markets that the Fed is aware of the longer-term intermediate risk that inflation will rise. And, you know, he wasn't very specific. Of course, this is a tricky time. In cycles past, when the Fed needed to tighten, it was pretty straightforward. We had a funds rate. They would give a signal that the funds rate was about to move up, and then shortly thereafter, they would move the funds rate up. This is a little different. There's this huge amount of liquidity in markets. Mm-hmm. The Fed now has several tools that it will choose among in implementing the exit strategy. And again, that's going to depend on how events unfold.
So you're looking for specifics from Ben Bernanke. Al, when do you ever hear Ben being specific?
Well, I think if I could read into his remarks what the sequence might be, they've already raised the discount rate once, and we now have a bigger spread between that and the near zero funds rate. I think the key thing to understand is the funds rate is not going to be moved before some other things are going to be done, and he mentioned some of those. I think the Fed will be engaging in some repo. They will try to drain some of these excess reserves out of the system. There are a number of ways they can do that before they raise the funds rate. One is to engage in some of these reverse repo operations, which would have that effect. There is the announcement that the Fed will make available to banks a longer-term sort of CD-like instrument that banks can move some of their reserves into. They're now paying interest on excess reserves. At some point, they're likely, before they raise the funds rate, to raise that rate. So there'll be some, they will perhaps at some point begin to actually sell into the market some of the longer-term mortgage-backed securities that they have purchased. So exactly how that's going to unfold is going to depend on the way the economy is behaving.
Okay, so asset sales might be a signal as to when the Fed may actually tighten. So, Al, let's get a prediction here. Do you think the Fed might be raising interest rates at least one time before the end of this year?
If I had to guess, and it's only a guess, I think you will see some increase in the funds rate before the end of the year, probably late in the year. But, it could easily fall into 2011. Again, it's going to depend on how things unfold.
Okay, let me talk to you about the recent Treasury auction. The sale is pretty disappointing. Would you say that maybe this points to a lot of distaste in the market for Treasury holdings at this point and not much conviction in terms of, I guess, U.S. debt?
Well, I think people are nervous. Bond markets are nervous, as Bill Gross said a little while ago. This maybe the best opportunities in that sector are past us. So, you may have some experiences with auctions that are a little bit tricky and a little bit difficult. But keep in mind, there's an awful lot of excess cash out there in global markets, and at some point, if rates begin to back up because there are difficulties initially, some of that money will then begin to flow back in. So I guess my main thought would be that the Treasury over the foreseeable future will be able to fund its debt. Maybe a few bumps in the road, but they'll get it done.
Okay, one more question for you, Al. You were the former Fed Bank president in Richmond. So what about this banking reform bill that Senator Chris Dodd has proposed? It seems to give the Fed a lot of power, including instilling this consumer protection agency at the institution and also giving the Fed Bank more power to wind down these too big to fail institutions. Some lawmakers, some Americans are really uneasy with this move.
Well, again, that's the case. And for a while there, a lot of people were focusing on the mistakes that the Fed made leading up to the crisis, and there were mistakes made. Although I think once the crisis unfolded, the Fed did a very good job of keeping it from playing our role in keeping it from getting any worse. But going forward, I think the thinking is now drifting back towards giving the Fed a primary role in dealing with the large institutions, the ones that are sometimes designated as too big to fail.
Okay, Al, I wish I had more time, but thank you so much for joining us. That's Al Broaddus, who's the former Fed Bank of Richmond president.